Howdy, folks. Welcome Liberty Call. Today is Monday, June 3rd, 2024. I am Raymond Dahlman, your humble host here at the Liberty Call. Looks like the markets, the S&P 500 and the NASDAQ decided to get into the green parade here at the end of the day. So they spent most of the day in the red. So I'm a little surprised at this late rally, but same thing happened on Friday, which was a little strange too. So anyways, hope you had a fantastical weekend. It was pretty nice here in Colorado. Got some chores done, cleaned out some gutters, did some weed eating, destroyed my weed eater because it was like 15 or 20 years old and would not stay started. So I beat the crap out of it on my driveway. I do have a rage streak still, even at the advanced age of 50. So anyway, went and bought a new weed whacker at Lowe's. So I might get to try that out either today or tomorrow and finish up the rest of the front of the property out by the street because it looks like it rained here while we were gone and it just grass grew like crazy. So in the deer are not eating it fast enough, unfortunately. So anyways, all right, you didn't come here to listen to me ramble about my chores over the weekend. You came here to talk about or listen to what happened in the financial news today, right? Right? Exactly. All right. Well, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell because you want to know when I go live. Because again, I say smart things once or twice a week. So you got to tune in every single day. All right, let's jump in and see what the markets were doing today. Dow Jones finished the day down 0.3%, 115 points, closed at 38,571. The S&P 500 was up 0.16%, 8 points, closed at 5285. NASDAQ up 0.56%, closed at 16,828. The VIX was up 1.7% today. It's at 1314. Canada down 0.68%, Brazil up 0.11%, and Mexico down 6.24%. What the hell happened in Mexico? Jeez. I know there was some sort of a glitch that happened in the markets today, which caused a lot of concern and worry, but 6%. Wow, that's a big jump. Anyways, all right. In Europe, Germany was up 0.61%. The UK down 0.15%. France up 0.06%. The Netherlands up 0.16%. Spain up 0.2%. Italy up 0.52%. Switzerland down 0.05%. And Portugal up 0.69%. Russian exchanges both in the red today. The MOEX down 2.14% and the RTSI down 0.99%. And the overnights, the Nikkei in Japan was up 1.16%. Australia up 0.77%. New Zealand down 0.1%. In China, the Shanghai was down 0.27%. The Shenzhen component up 0.07%. China A50 up 0.55%. DJ Shanghai down 0.4%. Hang Seng up 1.79%, and the Taiwan weighted when it closed on the 31st was down 0.89%. All right, and you can see how excited Jake is about the financial news. I mean, he is just on the edge of the carpet right now because he knows when we're done here, we're going out to play ball. Although at his advanced age, I mean, he's 6 now. He's kind of lazy when it comes to playing these days. All right, let's go ahead and get over to the weekly economic update. Stocks edged lower in the final week of May as fresh news on economic growth and inflation failed to inspire investors. Market shrugged off news that Q1 GDP was revised lower to 1.3% from the initial estimated 1.6%. Despite concerns that the economy was cooling faster than expected, it's not. Investors didn't believe that the update was enough to influence the Fed's decision about adjusted short-term rates. On Friday, investors were on edge waiting for the update on inflation. The Fed's preferred inflation indicator called the Personal Consumption and Expenditures, the PCE, rose 0.2% in April, which was in line with forecasts. Stocks rose slightly in pre-market trading on the news, but were under pressure throughout the day as investors digested the inflation update. But in the last hour of trading, stocks staged a powerful rally led by the Dow, which had its best day of the year. All right. So is bad news good news? On the economic front, last week's news was generally disappointing. The update on Q1 GDP was a bit discouraging, and several Fed officials gave seemingly more hawkish updates. Also, the Fed's Beige Book, which we covered in an article last week, revealed modest economic growth nationwide. Yet, despite the drumbeat of bad news, stocks were resilient and closed on only slightly lower for the holiday-shortened week. Yeah, it is. I mean, everyone's hoping that the bad news is going to trigger the Fed to lower rates, which is good news for the market because then Growth stocks will then go back up because anytime rates are lower, it helps growth stocks uh, on their projected future earnings. So anyways, all right, economic data for this week. Today on Monday is the ISM Manufacturing Index and construction spending. Tuesday, motor vehicle sales and factory orders. Wednesday is the ADP Employment Report and the EIA Petroleum Status Report. Thursday is jobless claims, international trade in goods and services, productivity and costs. And Friday is the employment situation and Fed official Lisa Cook speaks. Just a few companies reporting earnings this week. Tuesday is CrowdStrike and Hewlett-Packard. Wednesday is Lululemon and Dollar Tree. And that is the weekly economic update. Doodle-doo. Exciting stuff, I know. All right, let's get to today's market recap. U.S. stocks mostly lower on weaker economic data. Slump in energy stocks. All right, U.S. stocks experienced mostly downward trend on Monday, primarily driven by a decline in energy stocks due to falling oil prices and weaker manufacturing data, indicating a slowdown in the economy. Energy stocks dropped over 3%, which exerted pressure on the broader market. This decline in oil prices occurred as OPEC and its allies, known as OPEC Plus, decided to extend the existing production curbs until 2025, which is the next year, but announced they would gradually phase out some voluntary cuts after the third quarter. This move raised concerns about a potential supply surplus, especially at the time when the strength of crude demand is being questioned. Halliburton, Diamond Energy, and Baker Hughes were among the major decliners in the energy sector. In other news, Paramount Global saw a rise of more than 9% after reaching a merger agreement with media company Skydance. The offer from Skydance was increased to $8 billion, up from $5 billion, but the deal still requires the approval of the owners of National Amusements, which holds a 77% stake in Paramount. Additionally, MarineMax experienced a significant increase in its stock price following reports of a sale with OneWater Marine and a deal worth $40 per share. In the tech sector, AMD witnessed a decline of over 2% despite unveiling new artificial intelligence chips. On the other hand, rival company NVIDIA saw an increase of more than 4% after revealing its next-generation superchips that are set to succeed its current Blackwell chips. Furthermore, manufacturing activity in May fell more than expected, with high interest rates continuing to impact investment and expansion plans. According to Jefferies, the environment for capital expenditure investment remains challenging as long as interest rates remain elevated. Normal. Investors will be closely watching for the upcoming non-farm payrolls data for May, which is expected to provide more insights into the labor market. This will be a key consideration for the Federal Reserve as it approaches its next meeting, with expectations that the central bank will maintain steady interest rates. Yeah, the Fed is due to meet on the 11th and 12th, which is next week. All right, so that's everything there. Go over to our next article here from First Trust, Waiting on the Fed, written by Brian Westbury, their chief economist. Let's see what he has to say about the Federal Reserve. In recent months, a key argument has emerged that the Federal Reserve's shift from scarce to abundant reserve model has significantly influenced short-term interest rates. Since August of 2008, the Fed's balance sheet has grown dramatically from $870 billion to $7.2 trillion, equating to about 33% of GDP over the past 4 years, the highest in history. Consequently, market focus has shifted from economic data to interpreting the Fed's perspective, particularly Chairman Jerome Powell's views. Yeah, it's not data-driven anymore, it's just based on the seat of their pants. Previously, the market anticipated 5 or 6 cuts this year. However, there is now virtually no expectation for rate cuts in the upcoming Fed meetings in June or late July. This stance is consistent with the lack of progress in curbing inflation. The Consumer Price Index rose 3.4% in the year ending in April, an increase of 3% from the previous June. Despite a modest 0.1% rise in May, the year-to-year gains remains around 3.3%. The Fed also tracks other inflation measures. The PCE deflator rose 2.7% over the past year. Meanwhile, supercore inflation, that's in quotes, supercore, excluding food, energy, goods, and housing, things no one ever uses, increased by 3.4% and accelerated at 4.1% annual rate over the past 6 months. Dun, dun, dun. The inconsistency with the Fed's narrative has led to less emphasis on supercore inflation. The Cleveland Fed's median PCE inflation is at 3.3%, and the Dallas Fed's Trimmed mean PCE inflation is at 2.9%, both above the Fed's 2% target. Amid discussions of potentially raising the inflation target to 3%, because when you can't fix it, just change the numbers. Signaling a possible rate cut, the Fed's March dot plot indicated 2 to 3 rate cuts for the year. However, the market is skeptical, and upcoming dot plots may suggest fewer cuts. Given the current economic growth, persistent inflation, job gains, and strong stock markets, the rationale for rate cuts remains unclear. The focus on the Fed's decision highlights a problematic dependence on a government agency within financial capitalism. Ultimately, long-term market drivers will be innovation, entrepreneurship, and profits. AI's lack of concern for rates underlines this point. Regardless of the Fed's upcoming decisions, centrally planned economies appear functional until they fail. And we're in the midst of a collapse, so it is exciting to be here to sit and watch it. So, all right, one last article from the Mises Institute, their Mises Wire. This one's titled, Yellen Wants Price Inflation to Rise So the Fed Can Keep Spending. This was written by Daniel Lacal. Let's see what Daniel has to say. All right, the long-term forecast for higher interest rates complicates the U.S. borrowing needs, highlighting the necessity of raising revenue in budget talks, according to Treasury Secretary Janet Yellen, the dumbest person on the planet. However, the perspective is challenged by the Congressional Budget Office projections. The CBO estimates the 2025 primary deficit will reach $851 billion, with net interest outlays rising to $951 billion. From 2025 to 2034, the primary deficit is expected to average $676 billion annually, with $1.2 trillion in net interest outlays, accumulating at a $7.4 trillion primary deficit and $12.4 trillion in interest expenses over the same period. These projections do not assume any recession and anticipate rising tax receipts. Really? Yeah, because when we go into recession, tax receipts will go down. Despite these optimistic estimates, deficits and interest expenses are poised to soar, indicating that revenue measures cannot address the fiscal imbalance. Generating an additional $700 billion annually through revenue measures is mathematically implausible, especially given the cyclical nature of tax revenues and the potential impact of a recession. The unsustainable budget deficit and rising interest expenses are attributed to the government's refusal to adopt budget discipline. Yeah, shocking that cowards in Washington won't, stop spending our money. The administration perceives all expenses as necessary and seeks higher taxes on citizens' earnings. The deficit stems from excessive spending rather than inadequate revenues. The government spending escalates during economic booms and downturns, exacerbating the deficit burden. The situation poses a significant threat to the U.S. economy. The persistent deficit is leading to money printing, higher taxes, and inflation, which erode citizens' wealth while expanding government size. Keynesian policies characterized by deficit spending and increased government intervention disproportionately harm the middle class. Yeah, people like me and you. Yellen's stance implies no compromise on spending, resulting in inflation and higher taxes. This approach perpetuates an unfair tax system and places a heavy burden on the middle class. Government spending from January to May of 2024 already increased by 6% year on year, underscoring the difficulty of addressing the deficit through revenue measures alone. The Federal Reserve faces a dilemma. Curb debt costs while fiscal policy fails to reduce inflationary pressures. This situation necessitates reducing government size to save the U.S. dollar's purchasing power and prevent economic stagnation. Increased government control leads to inflation, higher taxes, and lower wages, making citizens poorer. Reducing government size is essential to avoid these detrimental effects. And who do you think is actually going to do any of these things? No one in Washington, because they're all scumbags. All right. Well, that is everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope everyone has a wonderful evening, and I shall talk to you again next time. Adios.